Then we are going to discuss the make or buy decisions. In make or buy decisions, to explain the make or buy decisions, first we will discuss the two terms that are vertically integrated organization and make or buy decision. In vertically integrated organization, the company is involved in activities in more than one production or one product. We can say when a company is involved in more than one activity in the entire value chain, it is vertically integrated company. When we will talk about a make or buy decision, it is like this. The make or buy decision can be defined as a decision to carry out one of the activities in the value chain internally. We will say it is a make decision. But the decision to buy externally from supplier, this is the buying decision. To explain the make or buy decision, if we say we are going to produce 8,000 units and direct material cost per unit is 6 rupees per unit cost. So 6 8s are 48,000 rupees. Direct material cost is there. Our direct labor cost is 4 rupees per unit. 8 4s are 32,000 rupees cost incur for direct labor. Our variable overhead cost is 1 rupees. So 1 multiplied by 8,000 is 8,000 rupees cost. Supervisor salary 3 8s are 24,000. The depreciation of per unit cost per unit is 2 rupees. So 2 8s are 16,000. The journal overhead cost is 5 rupees. So 5 8s are 40,000. If we sum up all these type of costs, we will able to get 1,68,000 rupees cost. If we are dealing with the making decision, we are producing 8,000 units. Now if we deal with the relevant costs, and in our buying decision we will be able to buy these 8,000 units at the rate of 1,52,000, and if we see the difference in production, our cost is 1,68,000, but if we take that buying decision, we have to pay 1,52,000 rupees. So there is a 16,000 rupees margin, and we need to make decision about the differential of making and buying cost, and we need to decide what is more favorable for the company. This is the make and buying decision. BUI buying. ठीक है? This is the buy decision. It is clear with this calculation that at the purchase of 8,000 units we have to pay 1,52,000 to the supplier. and if we are making the same 8,000 units, we need to incur 1,68,000 rupees cost. So their difference is 16,000, and it is the unfavorable condition because the organization have to pay more amount in comparison of buying decision. Then comes the concept of opportunity cost. Opportunity cost is that type of cost that instead of buying a burger, if we have the opportunity to buy burger, chips, and cold drink in the same cost, then it will make an opportunity for the buyer. Like if we want to buy a burger at the rate of 150 rupees, but in the same way there he have the opportunity to buy burger, chips, and cold drink on same rate, it will create opportunity for the buyer to buy 3 in 1 items in 150 rupees instead of buying single item. This is the basic concept of opportunity cost, that instead of buying one item in the same price, we will be able to buy 3 items. It can be done by survey, market conditions, uh, competitors move, and all type of steps that needs to be analyzed to know about the opportunity cost. Then comes the concept of special orders. Special orders can be defined as one time order that is not considered as part of company ongoing business but received on unusual basis, like we can say on special events, on special occasions. The order quantity is in bulk, but it is not usual business ongoing activity. It can be occur on special events. Then comes the concept of utilization of constrained resource. First of all, what is a constraint? Constraint can be defined as a limited resource that restrict company ability to satisfy demand. Like nowadays, due to the COVID-19, it is a constraint for restaurants to do delivery and parcel services instead of dine in service. Because of delivery and parcel services, their service charges are restricted. They are unable to provide dine in services, and the revenue of the restaurants is limited now. To commemorate the utilization of constrained resource, the concept of contribution margin per unit of constrained resource is there. For example, in dine-in services and takeaway services, the distribution of prices are as follows: the selling price per unit, variable cost per unit, contribution margin per unit, in dine-in services the selling price is 25 rupees, in takeaway service the selling price is 20 rupees, in variable cost per unit the dine-in services is of 10 rupees, and in takeaway services the variable cost is 18 rupees. If we sum up these, or we get the difference of this, there is 15 rupees and there is 12 rupees margin. There is only 2 rupees margin. So if we calculate its margin, it's a 60%, and here it is